and thanks again for joining us today on our webinar to discuss how you can empower your business legacy through an ESOP. For those of you who don't know me, I'm Todd Karansky. I'm a tax partner here at WBL. I started working at WBL as a tax intern in the summer of 1999, in between my undergrad and getting my master's degree in taxation from the University of Georgia. After getting my master's degree, I came on board full-time at WBL in January 2001 and have been at WBL ever since. I think the fact that we have multiple partners at WBL who have been here since the beginning of our accounting careers speaks a lot of strength to WBL's culture and why we are consistently ranked every year as one of the top accounting firms to work for in the country. Today, in addition to Petra and I, WBL is delighted and honored to have with us two distinguished guest speakers in Gary Gray and Holly Sims. Gary Gray is the founder of Graydaze Contracting, who had a 30-year career at Graydaze. He started Graydaze as a residential contractor painting houses in suburban Atlanta, and then moved on to becoming a commercial painting contractor company. Graydaze has since grown to become the second largest painting and sealant contractor in the country. In 2017, Gary sold Graydaze to an ESOP and remained the CEO until 2022, when he transitioned to a chairman role with Graydaze and then joined Tenor ESOP Partners. Post-ESOP, Graydaze doubled the size of its business 2 times in 5 years and has become one of the great ESOP success stories. Now a partner at Tenor ESOP Partners, Gary leads Tenor's construction practice. And at home, Gary enjoys life as an empty nester with his wife, Jenny, and after raising 5 kids. WBL is also proud to be the accounting firm for both Gary and Graydaze since 1994. Our second guest speaker that will be talking later is Holly Sims. Holly is a commercial bank manager at Georgia Banking Company. She is an Atlanta native and has been a banker longer than she'd like to tell people. Her vast experience in middle market lending and the fact she grew up in a family manufacturing business ultimately led her to her specialty and passion in helping companies with ESOP transactions through leveraged buyouts. Holly has been working with ESOPs for over 12 years now, including working with Graydaze and continuing to work with Gary in his role at Tenor. Holly is also the proud mom of 2 grown boys. And now I'll turn it over to Gary to start our ESOP presentation after we have a quick exit poll or quick poll for CP. So the quick poll question, how many employees are in your company? I guess we'll wait for everybody to answer and then we'll move forward with Gary starting his presentation. Thanks.
And also we will have a little Q&A session at the end of the presentation. If you have any questions that you want to answer at the end, please feel free to put them in the chat and we will go over them in the time that we have allowed. And if we run out of time, we will of course get back to you with an answer or discussion of the topic. Thank you.
Well, good morning, everybody. My name is Gary Gray, and I think if we can just go to the next slide when ready. So this kind of tells a story. Todd shared with you some highlights about my 30-year career leading a business called Graydaze Contracting. As you can see from the funny pictures here, I started like a lot of business owners doing the work, built a team, built a culture, built a client list that I was very proud of, and eventually grew the business to become the second largest painting contractor in the country. And like most business owners, starting off doing the work and growing the team, you eventually get to a point where you start to think about, how do I create a succession plan to take care of my team? And that leads you to start to look at exit strategies and how am I going to unlock the value in the business? And we can go to the next slide, Chinto. And the problem with so many of these exit strategies, looking for third-party buyers, is that, how am I going to take care of my team? You've got a dilemma. How do I maximize the value of my exit and my 30-year career building a business, but then also take care of that team to help me build the business and really put the business on the map? You can look to the inside in a management buyout or transition to family, but many times that's not an option. And when that's the case, I started doing a little more digging and came up with the idea of considering an ESOP. And an ESOP, and we can go to the next slide, An ESOP is a qualified retirement plan that invests solely in the stock of the sponsoring company. An ESOP is a way that we can create a win-win solution that not only creates a significant amount of value for the selling shareholder and rewards them for the career of building a business over a long period of time, but also takes great care of their employees. Uh, as I said, an ESOP is a qualified retirement plan that invests solely in the stock of the sponsoring company. It's going to look and feel a lot like a 401k plan to your employees with a big difference. The big difference is that it invests only in the company stock, so their work, their hard work, their effort, late nights doing what it takes to sell that next job or create a raving fan client will actually not only create value for the business, but also creates value in their retirement account. So I'm going to share with you first the 7 reasons why I chose an ESOP over these other strategies. And the first one, of course, is the fact that this is a employee windfall at retirement. This will be just like a 401k plan in terms of the taxation, but with the ability to create so much more wealth for your employees and really reward that team that helped you build the business. And it would seem that by doing this, kind act or almost charitable act, that you wouldn't be able to, that you'd have to take some sort of discount on the stock when you sold it. And that's absolutely not the case. The other reason why I chose ESOP over some of these other exit strategies was I knew that I could also receive fair market value for my stock. And in fact, I would tell you that if you're patient, an ESOP can provide significantly more wealth to you and your family than any of the other exit strategies that we shared a few minutes ago. So it's a windfall to your employees. There have been study after study of ESOP accounts creating 2 to 3 times the wealth for employees at retirement, and the selling stockholder is going to be guaranteed fair market value for their shares of stock. Otherwise, there's not too many business owners that would let us create this windfall for the employee. So employee windfall, fair market value. The other benefit or reason why I chose an ESOP is that it's also highly customizable. We can create ESOP plans that we can customize the financing, the amount of stock that we sell. We could sell, from 1% to 100% into an ESOP. We can create, phased sales. So the transaction is highly customizable. It's also a lot less disruptive than third-party sales. The negotiation is going to be a much friendlier negotiation than it would be in a third-party sale, and it tends to create a lot less friction and politics internally than even an internal sale might do. So highly customizable. The other reason is that my opportunity that I could still retain control of the business. When I sold the business in 2017, as Todd shared earlier, I stayed on and continued to run the business as the CEO for 7 years following the sale. From 2017 to, well, actually, I guess it would have been 5 years, to 2022, I remained the CEO. Then I transitioned to a chair role, named my new CEO, and was able to work alongside him for 2 years before retiring completely out of operations. So I was in total control of my succession plan and doing it on my own timeline. I was able to pick the team, the leadership team, work with them, make sure that the business was ready for them and they were ready for the business before I started turning over responsibility. And again, it was on my own timeline. So that's the fourth reason that I chose an ESOP over these other options. The next one, and some of these next 3 are really, probably lesser known benefits of an ESOP. But one of the other real reasons and benefits is I like the idea of the tax shield that an ESOP creates. Todd is going to do a deeper dive into the tax shield and the ability to avoid capital gains. But one of the big reasons that I chose an ESOP was the tax benefits that it provides for the company, that allows us to quickly amortize the debt that we're creating in an ESOP, to basically pay for the transaction or subsidize the transaction with tax benefits. The next tax benefit is the ability to avoid capital gains on the transaction. This is an IRS code that's been written specifically for the sale to an ESOP, and it allows the selling shareholder to avoid capital gains on the transaction. So the ability to avoid capital gains, and then the last reason, the second bite of the apple, these two reasons alone will allow, if you're patient, will allow the selling shareholder to create substantially more wealth for him or herself and their family than any of the other exit options that we talked about earlier. The ability to elect IRC 1042, which Todd will do a little deeper dive on, and avoid capital gains creates more net proceeds into the selling shareholder's bank account than any of those other exit options, and it's only available if you were to sell to an ESOP. And then the last reason, also a lesser known reason, is what we call the second bite of the apple. The second bite of the apple is going to be similar to an equity rollover, but it's different. Let's just for example, we sell 100% of the business into the ESOP trust. Then immediately following the sale, we're going to carve out 30 to 35% of that equity and put it into two buckets. The first bucket is going to be to reward the selling shareholder and allow the selling shareholder to take advantage of future growth of the business. The second bucket we're going to use to incentivize our key leaders. And this allows the selling shareholder to have total control and create equity awards for their future leaders, and to ensure that their business continues to operate strongly with good, strong leadership at the helm. So those last two benefits, avoiding the ability to avoid capital gains, the second bite of the apple, allows us to create significantly more wealth for that selling shareholder than any of those other exit options that we discussed earlier. So sort of in summary, it's a windfall for your employees. So it's a win-win situation, not only for your employees, but also for the selling shareholder, because they're guaranteed fair market value for their stock. The plans are highly customizable. The transaction's highly customizable. You can retain control, start turning over control on your own timeline, giving you a tool for succession planning. Then the tax shield, the ability to avoid capital gains, the second bite of the apple, all allow us to create additional wealth, or significantly more wealth, than some of the other options that we discussed. These are the reasons why I chose to go ESOP over a third-party sale. Let's go to the next slide, please. Well, it looks like they're asking you for what industry you're in. And I'm happy to answer some questions at the end of the podcast or webinar. And I'll be turning over next, I think, to Todd, who's going to do a little deeper dive on the tax benefits of an ESOP.
Thanks, Gary. So we'll wait a couple of minutes for everybody to answer the question. Looks like there's 6 people that haven't answered yet. So I'll give you about 10 more seconds. All right. Thanks, Gary. So we'll dive into some of the tax benefits of an ESOP. Some of these are lesser known tax benefits, and some of them are probably tax benefits you've heard of. And Gary was alluding to Code Section 1042 quite a bit. So we'll dive into that. So the ability for a seller to defer taxable gain under Code Section 1042. It's an election you have to make under Code Section 1042. And in order to get that tax deferral treatment, the sale must be structured properly and proper procedures need to be followed. There are a lot of detailed and nuanced technicalities in the 1042 deferral. Some of those are going to be beyond the scope of this discussion, but we'll go ahead and talk about some of the basic things to consider for a seller to obtain tax deferral treatment under Code Section 1042. First thing is that the stock being sold to an ESOP must be shares held in a domestic, privately held C corporation and held by the seller for at least 3 years before selling to the ESOP. In addition, the stock being sold cannot have been acquired as part of an employee benefit plan, such as a stock option plan. There's also the 30% ownership rule. So the ESOP needs to own at least 30% of the corporation immediately after the sale. And then the seller's proceeds from the sale of stock to an ESOP need to be reinvested in qualified replacement property to obtain the tax deferral treatment. The investments in replacement property are generally limited to things such as stocks, bonds, and floating or fixed rate notes issued by a domestic operating corporation. Thus, investments like muni bonds, mutual funds, partnerships in foreign entities are not going to qualify as replacement property. The good news is that most financial firms out there are going to have a 1042 platform that you can use to choose your investments for the qualified replacement property. The reinvestment in qualified replacement property also needs to be made within a 15-month window. That window begins 3 months prior to the sale and ends 12 months after the sale. This can prove difficult since the seller typically will receive only a portion of the purchase price in cash at closing, with the remainder structured as a seller note. Therefore, alternative financing arrangements must often be made by the seller to come up with the proceeds to fund the replacement property within 12 months following the sale. How to finance the funding of replacement property is beyond the scope of this discussion and should be discussed with your financial advisor. But anyway, careful consideration needs to be made with both your tax and financial advisors in deciding whether or not a 1042 deferral is the right move for you. I'll also point out that when making the 1042 election, there's strict disclosure rules that you have to follow on on the seller's tax return in the year they make the election. Also wanted to point out, not on the slide here, that there may be an ability to actually combine the benefits of a Section 1202 stock sale exclusion with the tax deferral benefits of a 1042 exchange. Thus, if the stars align properly for the seller, they could possibly get some of their gain entirely excluded from tax under the Code Section 1202 and defer the rest of their gain under Code Section 1042. The complexity of achieving these results are really beyond the scope of this discussion. I'm not going to get into detail on 1202. We don't really have enough time for that. But just wanted to point that out and also note that the IRS has never provided an opinion on being able to combine these benefits, but we believe that it could be achieved. Once again, the stars need to align properly in order for that to happen. So bottom line is 1042 deferral. You have to be a C corporation. That the company has to be a C corporation, and the various rules have to be followed. But you should be discussing this with your professional advisors and determine if the 1042 exchange is the right move for you. Even if the 1042 is not the right move for you, the seller can still get capital gain tax rate and installment sale treatment, which are favorable treatments. So the shareholders can, from selling stock, if you've held on to the stock for more than a year, the seller will get favorable capital gains rate treatment. It should be noted that oftentimes when you sell to a third party, if you're an asset-heavy company, the third party buyers usually going to want to do an asset sale, as they get favorable tax treatments from doing an asset sale, and this will create ordinary income rate treatment for a lot of the some or a lot of the sales proceeds, depending on how asset heavy your business is. In addition, as the capital gain, and usually, as I said, the sales usually happen on a seller note, so not all the proceeds are received up front. Thus, you can take advantage of the installment sale rules so that payments are taxed in the year they're received and not the year the stock is sold to an ESOP. Thus, the selling shareholders' tax paid on shares sold to an ESOP will match with the cash they have received thus far from the sale. In addition, if S corporation shares are sold, the seller can typically avoid the 3.8% net investment income tax. Unfortunately, the sale of C corporation stock, including the eventual sale of replacement property in the 1042 exchange, will be subject to the net investment income tax. You can move on to the next slide. So it's very important that you consider the structure of your company in advance of an ESOP transaction in order to ensure that you and your company achieve optimal tax benefits and avoid tax pitfalls. Your company must be an S or C corporation at the time of the sale to an ESOP. Thus, an ESOP cannot have ownership in an entity taxed as a partnership. If you're an owner of a partnership entity and looking to sell, and selling to an ESOP is a strong consideration of yours, you need to be discussing the possibility of converting to an S or C corporation with the other owners and your tax advisors sooner than later. As noted already, if you decide you want to move forward with the tax deferred gain under Code Section 1042, your company must be a C corporation at the time of selling shares to an ESOP. If your company is not currently a C corporation, careful consideration needs to be made with a knowledgeable tax advisor to avoid any potential tax pitfalls on converting to a C corporation. I should also note that beginning in 2028, up to 10% of the gain on a sale of S Corp stocks at ESOP will be eligible for 1042 gain deferral treatment. Thus, S Corps may be creeping into the ability to do a 1042 gain deferral as well. If your company is a C corporation at the time of selling to an ESOP, consideration should also be made as to whether an S election should be made by your company following the sale to an ESOP. Just be aware that there are built-in gain tax that could apply on assets held at the date of conversion to an S Corp if they're sold within 5 years after the conversion. As Gary indicated, the ESOP is a for-profit tax-free entity. It's thus exempt from taxation on unrelated business taxable income, including the activity from an operating S corporation business. Since an S corporation flows through its activity to the tax returns of its owners, the ESOP pays no tax on its share of the S Corp company's earning and cash distributions. Thus, if the ESOP is to own 100% of an S corporation company, the profits and distributions of that company can avoid all income taxes. However, I'll caveat that there are some states that still have an entity level income tax, so companies operating in such states may still have some state income tax liabilities as an S corporation. Ultimately, I'd say that the decision to be an S corporation or a C corporation is not an easy one. And whether or not to be that at both the time of the sale and after the sale will depend on your particular facts and circumstances. There's no universally right answer. The most recent survey conducted this year showed that about 2/3 of the companies that have ESOP ownership are S Corps, and another third are C Corps. Next slide, please. So while being an S corporation owned 100% by an ESOP can avoid most, if not all, income taxes on the company's profits and distributions, staying a C corporation or having taxable shareholders remain in an S corporation can still have some pretty significant tax advantages. This is because the contributions to an ESOP are tax deductible, including contributions to cash out ESOP participants and paying the interest on acquisition debt. C corporations also receive additional deductions that an S Corp may not receive for ESOP contributions made to pay the principal on acquisition debt. So they'll get deductions for both principal and interest, where an S corporation would just get the deduction for interest. And just be aware also that Code Section 404 rules for contribution limits are going to apply. This generally limits the company's maximum deduction on ESOP and other retirement plan contributions to 25% of employer compensation. However, C corporation contributions, to the extent used to pay interest on acquisition debt, are exempt from these 404 limitations, and C corporations are also afforded an additional deduction up to another 25% of covered compensation for principal payments on acquisition debt. Therefore, C corporations have a little more leniency in their ability to get deductions on contributions to an ESOP. Also want to point out that dividend payments from a C corporation to the ESOP or ESOP participants can also be tax deductible under most circumstances. And ESOP dividends received by participants are also not subject to net investment income tax, and the participants usually elect to reinvest dividends in qualified employer securities. If the dividends are not reinvested, they are subject to ordinary income tax. For the ESOP employee participants, they are afforded benefits similar to other types of company retirement plans like 401ks. Thus, the employee participants are not taxed on their ESOP participation until they receive ESOP distributions. ESOP participants can also defer tax upon exiting the company by rolling over ESOP funds to an IRA. And that pretty much sums it up for tax. A lot of complexities there, so feel free to ask questions. Now I'm going to send it over to Petra, who's going to talk about some of the ESOP accounting considerations and what you need to know. Thank you.
Thank you, Todd. Yes, there's a lot of nuances when it comes to ESOPs from the tax perspective. There's some unique accounting challenges as well. But as Gary has told us, it's a very rewarding exit strategy for a business owner and the current employees of the company. So absolutely something worth the time investment into figuring it out, how it works, and what needs to be aligned to maximize the benefits. So let's talk about the accounting piece. For the leveraged ESOPs, which is basically when the company, the sponsoring company, obtain external funding from a bank, and Holly is going to tell us more about that, and then loans the money to ESOP. A lot of the funds, the external funds from the bank, will go paid out to the business owners that are selling to the ESOP. So that's how the transaction is funded. Also, that's the redemption option that we are talking on this slide. With the external funding, there are repurchases of the shares from the former owners, and the outstanding shares, it can be a portion of the shares or all of it, 100%. The transaction gets transferred to the ESOP. So in this case, the redemption of the shares should be done in advance of the purchase by the ESOP to maximize the valuation to the selling owners. And then when the shares are being sold to the ESOP, it is done at a lower valuation when the external debt is already in the books, and the fair value of the company declines because of that. Next. So for externally leveraged, the ESOPs borrows directly. You do not see that as often because there are some terms, the repayment terms are not as optimal, and the conversion of the shares over to the ESOP is on a very short time frame. So that is typically being avoided. Next slide, please. So for the recording the initial ESOP transaction, again, it's a little different animal, so we want to pay attention to what all needs to be recorded. And we also have a little accounting manual on our website where we go in more detail how the transaction is supposed to be recorded. So please see the link here. It's also on our website. If you come into a specific question or actually are going through an ESOP transaction, it is there in more detail. But you do have to record any of the external debt, of course, that is being borrowed, and any equity instruments that are being issued with the transaction. It can be warrants, it can be stock options, or synthetic equity like management incentive plans, stuff like that. That anything that is providing the second bite at the apple also to the owners that Gary was talking about is included in this category. Then we need to record the cash that was received from the issuance debt, and then it's typically paid out back to the owners. There are maybe some subordinated notes that are being issued to the former owners as well for any excess value that the company does not have a cash to pay out yet. We also have to record the redemption and the reissuance of any outstanding shares. That can, again, be the 100% or less of a percentage of the outstanding shares of the company. What is one unique thing that you do not really see anywhere else is the note receivable from ESOP. So the money is being loaned to the ESOP, and the company has a note receivable from ESOP. That is recorded as a contra equity on the balance sheet within the equity piece. It's not an asset of the entity, and it a lot of time results in a negative equity on the company. And that's why Gary said, be patient. It will turn into a positive position over time, but after the transaction is recorded, it looks unusual, I should say. So let's go to the next slide. So the next maybe overall accounting issues that we should consider when we are recording ESOP transaction is that if there is no change in control, and that's the typical scenario in ESOP transactions, because the owner typically retains some control, As Gary mentioned, he was really working with his leadership to transition the company over time. That's the typical scenario. So the former owners are still in control. They also control the board seats of the company and the trustees for the ESOP. So there's really no option to apply push-down accounting. But if there was truly change in control, ASC 805 for business combinations would apply, and the company would have the option to apply push-down accounting. The other issue to keep in mind is that even if ESOP borrows the money directly, the ESOP debt has to be recorded by the sponsoring company because the ESOP has no ability to repay the debt without the sponsor payments. Next. So for the annual accounting, what needs to happen on an annual basis, the company holds typically the shares as security for the loans to the for the loan to the ESOP. That would be disclosed in the financial statements for the company. The shares are being released annually to the ESOP as the company commits to pay contributions and dividends to the ESOP based on the repayment terms of the loan between the company and the ESOP. And the ESOP then uses it to pay down its loan to the company. It's a non-cash transaction, which makes it very easy, but it is something that needs to be recorded on the books of the company and the ESOP. So part of the transaction gets also recorded as a compensation expense and on the income statement. It is typically shown as a separate line on the income statement by the companies if it is a significant amount. And then also we have to keep in mind that if there is a change in fair value of the warrants or other equity-based compensation instruments, they need to be valued and they need to be recorded. Next. So our next quick poll question is, are you a business owner? So that's a quick one. So I'm gonna move along. And I'm gonna turn it over to Holly, our bank specialist, who is gonna talk about ESOPs. She has a long-standing relationship with ESOP-owned companies. Holly?
Hey, thanks, Petra. The first piece I'm going to touch on is, my personal story. See if this, there we go. Why do you need a bank that understands the ins and outs of ESOPs? And, that kind of starts off with my own personal story, which Todd touched on early on. I grew up here in Atlanta in a family manufacturing business, and we had a shareholder dispute. The current ESOP, where someone could have the ability to do an ESOP and buy out another partner, really didn't exist back then. The company was sold to a strategic, and I watched people I'd grown up with my whole life. Strategics do what strategics do, and they closed down the Atlanta headquarters, moved things here and there, and I saw people I'd known my whole life lose their jobs. And I had a career that stayed in banking because I was not going to be now the third or fourth generation that was able to join the business. Fast forward, as I got into my banking career, I learned about ESOPs, and I went, wait a minute, this could have actually worked and helped save a family business. And I became fascinated with it and continued to push on with it, and was lucky enough in 2017 to be introduced to Gary and his company, help finance it, and watching what an incredible success story it was for both him, but also for the employees who have grown to know and love and work with. And it's been a great ride and a lot of fun. So why do you need to have a bank that understands the ins and outs of ESOPs? Because, as we all say laughingly, money's green, and money can be the same thing. A loan is a loan, and you deal with it. But as Petra touched on, there are a lot of things that happen to the company's balance sheet. And with the resulting piece of that, there's things that happen to the cash flow that an ESOP banker needs to understand. For starters, a typical banker that opens up a financial statement and sees a large negative equity, which Petra was talking about, is created when the ESOP transaction happens, it would probably be panicked, because typically you see a negative equity come from losses or other things. And this is just from accounting. And we need to know that and understand it. There are also quite a few cash flows that flow through the business that are non-cash items that you wouldn't be aware of if you weren't familiar with ESOPs. But more importantly, I think it gets back to how do we structure loans, and what do we do as lenders, and what do we understand as people that are very familiar with the ESOP industry. For starters, the default rate of an ESOP loan for a bank is far lower than the default rate of a traditional commercial loan, and substantially many times lower than with private equity. What does that mean? That means we can structure things on a cash flow basis. That means we can look at things more creatively than we might be able to with other types of things. We have to know the management of a company incredibly well. That's probably where we spend a lot of time digging and diving and understanding, because people like Gary, who built Graydaze and ran it, are going to be the ones that are going to help us through this ESOP, help with the debt, help pay it back, and the management team is really critical. The other piece, and for people that are contractors out in the industry and who are small business owners, this will probably be the most shocking one. There are typically no personal guarantees in loans to ESOPs. Why is that? And that is a departure from what we usually see. It's because we understand the strength of the ESOP, those things, and that seller note provides a great deal of security and safety for a bank. So it's different. It's very different from structuring a traditional commercial loan. And then the other reason for having somebody that understands ESOPs, we've got the transaction that happens initially, but it goes on for a long time, as Gary can also attest to. We have redemptions that happen. We have employees that may leave, and we've got to deal with their stocks. We've got to chat with companies and make sure they're providing and maintaining enough cash to deal with that. We're going to have that second bite of the apple come at some point in time. We're going to need to understand how to finance that. How do we help you pay for that piece? What things can we do to help guide and bring a company along through there? So that's where having an experienced ESOP professional is really helpful. And I'll put in, before we tie that up and I talk about the banking environment, I'll put in my own personal plug for Georgia Banking Company. And, you know, having, we are a community bank with a business focus. You have a lot of us that are experienced. I think that's another code word for being old. But you have very experienced bankers that understand things that have nuances, like ESOP lending. But you'll have the feel here of a community bank where I can go next door to my credit partner, who Gary knows well, Caroline, and ask her, hey, can we tweak this? Can we change this? Can we be flexible? Can we do things? And that's one of the wonderful things about dealing with a smaller bank as well. And then probably what people want to hear more about is what's the overall environment out there? You know, what are we seeing in the overall banking environment? You saw the announcement last week of Synovus and Regions, excuse me, not Regions, Synovus and Pinnacle. And we're seeing more and more consolidation. We are a heavily regulated industry. That means expensive and a lot to comply with that. And so you either have to be under 10 billion in assets, like we are at 2.5, or you've got to have huge scale to be able to comply with what's asked when you are over that threshold. I think we're going to see more continuing consolidation. And I think you will see more and more separation big giant banks and smaller ones out there, and less of that middle tier and medium sized. Under the current administration, we're seeing some regulations relax. We're still heavily regulated. I laugh all the time that it's easier for me to give you $10 million than it is for me to open a checking account because of all the things that we have to comply with, but they are beginning to relax and change a little bit. The current lending environment we're all looking for assets. We all still need to conduct business and do things. I think there's some eyes to the economy, and I laugh a lot of times that it's the tale of two economies. There is things that we see. All my clients are doing wonderfully. People just like Gary's business, going gangbusters, making great money, but we hear issues out there in the economy, and there's also the regulation. We're looking at that and staring hard at what's happening. So I think that hopefully gives you a feel for where the environment is. We're pro-business, we're doing business, but we're all kind of staring and seeing what's going to happen. And I laugh, if I could predict interest rates, I wouldn't be sitting in this chair talking to you. So I'm not sure where they're ahead. And thank you. Appreciate the time to talk to you.
Thank you so much, Holly. And just the statistic you shared with us that, ESOP companies are much less likely to default than other type of ownership tells you how successful these ESOP transactions are. It's really a win-win for the employees of the business and for the owner, as Gary has told us. He has fallen in love, of course, with the structure. Now he does consulting for ESOP or companies that are considering ESOPs. So it is something that we are all very passionate about. The last quick poll that we have for you is, did you learn something new today? Hopefully, yes. Hopefully there was one tidbit that you haven't heard before. Again, that's a very short answer. So I will go ahead and move to the Q&A portion of our webinar. So I have a couple questions that are coming up, and that is, do we need to engage a valuation specialist for the ESOP transactions and maybe then on annual basis? And the answer is yes. It is a stock ownership plan, and it is regulated. The government wants to make sure that the employees of the company are protected. So valuation is something that is required. It is one of the administrative tasks and costs that a company will incur going forward. But again, it is a small cost to the overall benefit to the business owner and to the employees. Gary, you have something to add?
Yeah, Petra, if you don't mind, one of the common misconceptions we hear is that ESOPs are complicated and difficult to maintain and administrate in the future and costly. I would tell you that it's absolutely a misconception, and that is the only additional requirement is that we have an annual evaluation. Everything else about an ESOP that's required is going to be very similar to what you would do with a 401k plan that you're probably already doing. So I would tell you that not only is it not very expensive, but the tax benefits that you get on an annual basis easily offset any additional costs that you may have in administrating it. And the business, as Todd and I love to say, it becomes a for-profit tax-free entity, and you can just imagine the competitive edge that it gives you in your business. So it's a small price to pay, very little administration in terms of cost ongoing.
Thank you, Gary, for the clarification. And right? You were involved with the business when it became an ESOP. So
Absolutely.
You're talking from your personal experience. So thank you for that.
You bet.
Another question that we have is for Holly. Holly, how will a line of credit impact my company's ability to leverage an ESOP transaction?
Most companies, when we go in and are putting in the ESOP structure, most companies will have a line of credit in that structure. So to be honest, there's really no impact. A line of credit unless it's fully drawn and has been for a long time, and then we have to consider that debt in there. Probably most of the companies that I work with and start talking to already have a line of credit in place, and a banking relationship.
Do you typically see that the line of credit would remain, or that you go ahead and refinance everything under one bank?
No, we, well, you will refinance everything with one bank because we've got to have control and viewpoint of all of the debt that you have for the most part. Sometimes you'll have, equipment debt with manufacturers and other things. For example, Gary's gigantic F-150 fleet that I laugh, they look like a truck dealership out there. That was outside of our banking facilities, but typically we have all the lending things. I personally want to see a company have a line of credit when they go into an ESOP transaction, and we'll build that into my structures so that you have an ability to manage cash flow and swings and receivables and payables and so on.
Okay, perfect. Thank you, Holly. And then there is a question for Todd. If you do a 1042 deferral and you do not sell the qualified replacement property before you die, what happens to the qualified replacement property investments?
Good question. Thanks, Petra. So the good news is that there is no gain recognition from an income tax perspective on that qualified replacement property when you die. It goes into your estate, your will or trust, and is guided by that to the beneficiaries of your will or trust. And those beneficiaries are then going to receive a step up in basis equal to the value of those qualified replacement properties at the time of your death. Now there may be estate income tax implications from that because your estate's going to include the value of that qualified replacement property in it, but there is no income tax at the time of your death. So that is good news for people if you hold on to your qualified replacement property long enough.
Okay, thank you, Todd. Holly and Gary, is there a question that you typically hear from companies that are interested in the structure that we haven't talked about yet?
I think the question I hear many times is the concern about the level of debt that an ESOP takes on. And that can make someone who has never borrowed large sums of money in the past a little bit uncomfortable. And so I do get asked a fair amount about that. We underwrite very carefully to make sure that the clients can kind of withstand some ups and downs in economic cycles. And again, I'll go back to that default rate. I mean, ESOPs are incredibly stable. And so with that, that leads you to the thought process that yes, they can handle the debt and they can usually handle it pretty easily.
Thank you, Harley.
Yeah, I would tell you, Petra, that the questions I typically get are just really clearing up misconceptions. And the two main misconceptions I hear are generally around value and control. The first one is that, for us to do such a charitable act, almost act of benevolence for our employees, we have to be taking a discount on our equity. And, it's absolutely not the case. It's 100% false. And in fact, as I had pointed out, if you're patient and you've got a little bit of runway, you can actually maximize the value and create substantially more wealth than you could in most of the other exit options, all the other exit options, because of the tax benefits, because of the second bite of the apple. The second one that I always hear is around control. People are always concerned, do I sell 49 or 51% of the business? And that doesn't, when you're selling to an ESOP in a properly structured transaction, we're selling ownership and not control. So again, the business owner, the shareholder, will maintain control for as long as they want to and be able to relinquish operational control over time to the people that they pick. So again, it becomes a big succession tool for key leaders. and
Perfect.
owners.
Perfect. Thank you so much, Gary. Yeah, ESOP can be a wonderful retention tool as well, right, for the employees of the company, because as Gary mentioned, it is wealth transfer to the employees, really. Sometimes the companies do not do as good of a job in communicating the value to the employees. It is something that they should really focus on, because it is tremendous value that is being passed on to the employees. And it is, as we said, win-win for the owner and the employees of the company. So thank you so much for your time. We are gonna rerun the first post question because it did not work properly. So now you have it here. Go ahead and answer it. And we will also provide any CPE certificates within a couple of days to all the participants. I know some of us are interested in that. So thank you for answering. And again, thank you for your time. Hopefully this was valuable to you. If you have any follow-up questions, please don't hesitate to reach out to us. We will be happy to answer them. Thank you. Take care.
Thanks, everybody.
Thanks,
for having
all.
me, everybody.
Thank you.